Having $5 million or more in retirement doesn't mean you're safe. In 2025, there are risks lurking under the surface that can quietly erode high net worth profiles if you're not paying attention. On today's episode, we're going to dive into high net worth portfolios and how to make them successful. All right. Good morning, Dave. How you doing, buddy?
I'm great, Derek.
You are back again.
It's like I've never left.
We got Tony on assignment again, I guess, going to San Diego. So you get to fill in again.
It's so exciting.
Well, hey, thanks for joining us today. Today we're going to talk about high net worth portfolios. So I realize that not everyone might not have a high net worth portfolio. But even if you don't, there's still lots of topics in here that we're going to talk about that can be applicable to, really any situation, especially when you talk about composition of like a portfolio and things like that. But, we do get cases, with 5 million or more. And I do think it's important, if you're in that boat, to the easiest way to say it and how I like to say it to clients is, realizing that you're in a different category and that you don't really have to just do I don't really want to call them the simple things, but there's kind of another level that you can get to based on asset levels in a high net worth portfolio.
Yes, Steve, that's just it. You kind of stole my thunder a little bit.
Oh,
but
I'm sorry.
No worries. It's all about like levels, like you said, and understanding like this stuff isn't all cookie cutter, right?
Yep.
We get it like, hey, not everyone's got a $5 million retirement portfolio. It might be a good problem to have, but at the same time, these concepts, the under the hood of what's going on, you need to understand where you sit financially, or where you're tracking, even because there's some planning involved, so that you can understand how do I make my situation most efficient. Because there's different levers you can pull depending on where you're kind of landing in the overall net worth landscape of things.
Yep, for sure. So, and something we talk a lot about, taxes. So with bigger portfolios come different and more tax risks. So we have to be cognizant of that. And then obviously estate planning issues, I'd say, are two of the main issues away from investing. So lots of boxes that you have to check off to make sure you're doing things right with a high net worth portfolio.
That's right. And the most common one that I hear from clients, in this situation is, let's look at that case. They've got, close to $5 million in a qualified type of an account. Well, when you come up on RMD age, required minimum distribution age, at 73, in that example, that couple with $5 million, they need to take around 4% out annually to hit that required minimum distribution. You're talking about $200K approximately of income, so that's already putting you into above the 12% tax bracket. Now you're in the 22. But the other thing you're kind of bumping up on without even trying is now you might be impacting your the cost of your Medicare.
Right.
So your Medicare premium, it's right around in the low 200s. It's on a 2-year lag, like a look back, but potentially your cost of your Medicare is jumping as well because of your high class problem, we'll call it, high class tax problem.
Yeah, for sure. So obviously, or not obviously, it's a very important factor when we're looking at income solutions for our clients, especially in the high net worth category, because like Dave said, your Medicare costs are going to go way up, with higher income. So something you have to plan for, and something that you have to look for, if there's ways around it on how you take your income. So, let's tackle some of the risks that can get involved when we talk about a larger high net worth portfolio. And I would say this is probably one of the most common ones that I see. Concentration in tech, AI, and probably specifically Magnificent Seven stocks. So you're obviously there's more money in there, so people feel like they can take more risk. But basically, they pile the risk all into one category.
Yes.
inside that tech sleeve. So when the tech sector gets hit hard, the portfolio really feels it.
That's exactly right. And to me, it's like it's about a mindset shift. It's
Yep.
kind of like when you're building and you're getting there, you're willing to take on certain levels of risk to grow your portfolio to amass the net worth that you're shooting for, to give you that flexibility. And then just like it's kind of like the analogies in sports, like if it's at the third quarter and you've got a huge lead, like there's no sense in just bombing the ball down the field for the rest of the unless you're playing a video game. But in real real sports, like at this point we're changing our play calling, we're draining the clock, we're using up all the time on the play clock to kill that clock because you've already won the game. So now let's just not let things slip through our fingers.
Yeah, for sure. Dave's a big fan of the wildcat formation especially towards the goal line.
I don't trust my quarterback. I'm putting in the running back or my tight end. He can fumble at the goal line too.
But we digress. So yeah, you hit the nail on the head there, and I think this next risk number 2, interest rate and bond market exposure. In a high net worth portfolio, you don't have to just buy the aggregate bond fund or total PIMCO total return bond fund or whatever the case may be. You can get a lot more pinpointed on how you manage your fixed income and your bond exposure. Like I said in the open, you don't need to do what everyone else is doing. You have more power, more purchasing power, so you don't have to just ride along in these huge bond funds. You can get a lot more specific.
Yeah, that's right on. And the most typical thing we see is we'll build out, to your point, like laddered bond strategies, whether it's
Yep.
T-bills or other notes that are coming due at intentional times in the future to kind of pre-fund a year, 2 years, 3 years, up to 5 years of expenses. Like it takes the interest rate risk part out of it, and we know we're going to get that set amount at that point in time in the future, and it's going to line up with our spending patterns.
Yep, absolutely. And when people first sit down with me or with us, especially in a high net worth situation, they probably have no idea how much they're spending on a monthly or annual basis. It probably also fluctuates. If we're meeting with people right before they retire, they're probably in the highest income phase of their life. So narrowing down kind of how much income that you do need, and setting up a plan for that income. That goes if you have a $500,000 portfolio or a $50 million portfolio, you still have to dedicate the right assets towards funding your expenses.
That's right. That's right on.
And I think even with the high net worth situation, if you build out a diversified portfolio with a specific income plan, that's going to allow you to do more with the other assets that you're not using for that income, which I think is really important. Probably what a lot of people want to talk about and and hear about are the higher flyer type of investments. But when you have that base down, it allows you to be more aggressive if you want to be.
That's well said. It's like the thought is like, I've got the basics covered with the safer bucket, and this frees me up to give me more risk capacity on this part. I'll call it my slush fund, where I can, it's all about right sizing. Like I want to be more aggressive. I'm interested in this space. That's great. Let's just right size it, so if it goes sideways, it doesn't ruin the whole plan, right?
Yep.
So that's kind of the idea of how you mitigate risk, and you make sure you're taking the appropriate amount of risk for what your objectives are.
Yep, for sure. And I think we can probably mention some more private investments in this section as well that can provide for income, and even quite honestly annuities. We're coming up on the end of the year here, so we're getting into our 2026 predictions. So I'm sure we'll do a show on that here coming up soon, but there's not a lot of negative news out there, I would say, but the market kind of feels like it's kind of a little toppy. That you can't manage, especially in the position that we're in, based on feelings and things like that. So you got to stick with the data. But in this situation, especially a high net worth portfolio, if you have a $5 million portfolio, and you just had a 12-14% year, call it $500,000-$600,000 that you made. I'm a huge proponent of taking some of that, sticking it into an annuity, and basically using that annuity as part of your income strategy. You kind of locking in some gains. It's a boring investment compared to other stuff that you can do, especially in a $5 million portfolio. But it's still helping preserve the assets, and it's also giving you kind of a little diversification in the bond section.
That's well said, and it's all about having the right mix to get you through the lean times. We'll be the first to tell you our crystal balls are broken.
Yep.
So plan for the market to not cooperate at some point in time, right? But if you structure yourself in a way to withstand the storm when it's there, that's the whole idea behind this. You can eliminate the problem of the worst problem, which is being a forced seller. So, asset prices are depressed, maybe the stock market's out of favor, you have all your assets in stocks, and you need $5,000 to pay your bills that month. Well, guess what you're doing? You're selling a stock that's beaten up.
Yep.
You want to have that spread out, that diversification, so you can pull from areas that have held their ground and get you through those lean times.
Yep, for sure. So risk number 3, healthcare and long-term care costs. So, I don't want to dwell on this too much, but it's very important. So if you, again, $500,000 portfolio or $5 million portfolio, you got to account for healthcare costs in your retirement plan. They are increasing faster than regular inflation. It seems to be a runaway problem. We won't blame anyone like Obama or anything like that, but healthcare costs are out of control. So we have to be able to account for that in our plan. And I mentioned estate planning. Long-term care costs can, if you're in that situation and you have, a large estate, and you have a long-term care situation where you're going into a nursing home for over 5 years, that can crush the overall estate. It's extremely expensive, and probably someone in that boat doesn't really want to, go to a Medicaid facility or a lesser place. So understanding what long-term care is, how you can insure for it, is an important part of this portfolio, of this plan as well.
That's just it, and we don't know if that stuff's going to be part of your life story. But that being said, like the idea is at least do some planning, put some thought into it of like how will I attack this problem if God forbid it does surface. What are my next moves? Have that planned out in advance. You don't want to be what we call in crisis planning,
right?
Where something just occurred and now I have 3 days to figure out what I'm doing next. That's not where you want to be.
Yep. So if you do have a high net worth portfolio, long-term care planning, estate planning, very, very important to make sure you have all your ducks in a row in that aspect. All right. You want to tackle number 4 here?
Yeah, number 4, black swan events and over-hedging. So the thought here is sometimes we come across like portfolios for prospects that'll come in, and it's like, hey, I feel like I'm diversified, right?
Mm-hmm.
And we have an X-ray software tool that kind of lets us look at under the hood how you're actually invested, because you may have 100 different funds or 100 different ETFs and a basket of stocks, and then when we run our analysis on it, our diagnostic, in actuality, like you have a lot of different security names, but they're kind of all investing in the same thing. And most recently, what we've seen is like tech, that mega cap tech sector has kind of taken over even the generic indexes. So when you have that concentration and then you layer on your favorites, the Googles, Nvidias, like a lot of times you're doubling up on that stuff. And I think investors just don't realize maybe how many of their eggs are in the same basket.
Yep, for sure. And I'll that's well said. And I'll just add one more point on the over-hedging, because I do see this in practice from time to time, and it does seem to be from more of the higher net worth people. When you try to time the market, you'll eventually be wrong. So. What I mentioned a little bit earlier on an annuity, I don't want to throw out specific numbers, because that's not what we're doing here. But you can capture with certain products a large portion of what the S&P 500 returns. So that's kind of that is a hedge where you will still see upside if the market appreciates. Just going to cash or going into short-term bond funds that are pay 3% a year. When you do try to make those timing calls, you will eventually be wrong. I have never seen them help a situation, honestly. So, and again, it's very difficult. But I've throughout my whole career, I've never had someone call in and say, "Hey, I'm worried about the market. Let's go to cash in 10-20%." I've never seen that work out well.
The problem with that one is you have to be right twice.
Exactly.
So the first part, a lot of times people will catch and they'll say, hey, look at, I made this call and I got more conservative, and just like I thought, the market went south. The second leg of that is the hard part, because how that story plays out is after the market drops. So say it's April of 2025 and the S&P is down 15 to 20%. A lot of people at that point they get more scared.
Right.
And now the sky's actually falling, and the last thing a lot of people want to do is go and turn around and become an aggressive investor. So you really have to know yourself, know your risk tolerance, and from what we've seen, the same people that call in that the sky is falling, they're not calling us when the market is actually depressed, when it's actually the valuations are more attractive to get back in, and that's the hard part.
Yep, for sure. So yeah, the practical steps for next year or for the end of this year, if you're in this high net worth situation, I'd say number one, just reassess the concentration and sector risk. Just because you have more assets to invest doesn't mean that you just need to kind of blindly get into the more risky asset classes. Fixed income, it can be a huge bonus for you if you have $5 million or more, because you can get more specific inside of the bond funds and how you invest in fixed income. Excuse me. Include healthcare strategies inside of your plan, long-term care strategies especially. And then stress test your portfolio against multiple scenarios. We don't want to be trying to time the market. Get a good asset mix. Make sure you have your income strategy. And remember, it's a long-term proposition. So, those are kind of the four things we took a look at today. Dave, any final thoughts?
Final thought for me is just, it's all about planning. Meaning, it's so much easier to make a rational, well-reasoned decision in advance of the event versus waiting for the stress of the moment to hit and then, really white-knuckling it and trying to figure out what to do in that moment when their stress levels are so high. So take some time, think through some of these things so you can kind of go on autopilot and say, hey, we already know what we're going to do in this scenario, and it kind of takes the guesswork out of it.
Absolutely. Planning is going to lead to lower stress in your retirement. I think that's the easiest way to say it, because these markets are cyclical. It's never as bad or as good as it seems for 99% of the time. So get your plan together, execute it, and make sure you have thought about the nuances of a higher net worth portfolio. So, well, Dave, thanks for joining us today, for filling in again. I really appreciate it. We will be doing quite a few topics here at the end of the year, probably get into some of the end of the year predictions. So you've been filling in so often, we might have to have you in with Tony as well to do those. But thanks out there for listening. We appreciate it. If you guys have any questions, comments, or concerns, hit us up at info@swpconnect.com, and we'll talk to you next week.
The opinions expressed in the podcast are for general informational purposes only and are not intended to provide specific advice or recommendations for any investment, legal, financial, or tax strategy. It is only intended to provide education about the financial industry. Please consult a qualified professional about your individual needs.